Did you know that most people think that IRS audits are random? Just so you know, they're not. There's no such thing as a random audit. It's an urban myth. Don't believe it. Audits are triggered by financial behavior, typically by different things on your tax return. And most of these triggers are never explained to just ordinary taxpayers. You find out the hard way after you've been audited what the triggers could be. So today I'm going to go over some of the triggers for audits. Here's a little frame of reference. 2014 through 2022, I did an audit a week before the IRS. All TurboTax filers, none of the returns I filed. That's what I based my experience on. I've been working for IRS audit people for a long time. And for the last 6 years, I've been working with former IRS. So I know a bit more about audits now than I did then, but I've written a couple of books about it, okay? So let's go over the audit triggers, or the triggers that put you on the IRS's radar. First and foremost, no rumors, no scare tactics, just patterns. Patterns of behavior that repeat themselves over and over and over again. The biggest misunderstandings about audits are the mistakes that cause them. They usually aren't mistakes. They're usually decisions that people make that they thought will get them a good refund. The IRS looks for the stink. Like, you can smell a sneaky fish like a block away. The IRS can look at a return and they look for the stink. What doesn't line up on this return? What doesn't make sense? Let's give some examples. You have $1,500 worth of income, $80,000 worth of expenses. Can you see the stink? They did. That's an audit right there. And they don't do it every year. Typically, they might see it 1 year, they'll see it repeat a second year. That third year, they're gonna pull that second and third year for audit. And if it's a tasty victual, they've made some income on that, they're gonna pull another year on you. Oh yeah, that's what they do. They collect tax, that's their job. You know that, right? The IRS's job is to collect tax. So if they find out that in an audit situation, you're creating expenses don't naturally exist. You're putting deductions on your return that end in double zeros. Hello, red flag, double zeros. No math actually works out like that. You don't round numbers, you give them actual figures. In an exam, that's what they call it. That's an audit. It's called an examination. The letter you get says, we've chosen your 2022 tax return for examination. Well, guess what? That's an audit. And it's not just because they're guessing. This is a cash grab for them. They know they're going to make money. Now, if you have representation, things could go a little better, but it really comes down to your actual records. So if your return ends in double zeros and your records don't support that, yeah, they made some money on you. That's one of the red flags, because the IRS already has all of your income data, your W-2s, any 1099s you received from like interest from the bank, or maybe you did some subcontracting work on the side, or maybe that's just what you do. You do work on a 1099 basis. They have records of income. They know how much you're making. And if your return doesn't line up with what they're seeing your records show, that is a red flag. Not always an audit, but you're definitely going to get your return reviewed. The computers select returns for review. Human eyes look at the returns for an audit. And reviews are where audits start. Another trigger is large changes without reasonable explanation. The IRS has an acronym for that, LUQ, large, unusual, questionable expenses. Yeah, LUQ. They see LUQ. That's what they say. Little LUQ there, huh? And that's how they do. They're just going to shrug it off. And then they examine your return. So what are large, unusual, questionable? Well, if your income drops significantly in a year, or your expenses ratchet up, like I mentioned, that $80,000 worth of expenses for $1,500 worth of income, that's LUQ right there. Now, to you, there may be a good reason. And if you have support for those reasons and you're audited, no worries. You just bring your support. However, the IRS is auditing because they want to know how you arrived at your figures. If you arrived at your figures incorrectly, there may be a correction on your return. What does that mean? Some of your expenses turn into income. Not a pretty sight. Because to the IRS, kind of looks like your story changed. They don't say you're lying, and they don't use the F word. They say LUQ. The F word that I'm referring to is fraud. That's the technical term for you didn't really tell the truth on your return. They don't like to go in that direction because then they have to involve their legal department. That's not really easy. It's more expensive. And if they can make money on you by just auditing your return, it's a lot easier. So the penalty for fraud, 75%, 6663 is the Internal Revenue Code. They'll go 6662. Negligence or disregard for the law. 25%, it's good enough because there's interest on top of the penalties. They're there to collect tax. That's the IRS's job. And I mentioned self-employment. Self-employment gets a lot more attention because the IRS actually has a division called Small Business Self-Employed. The acronym is SBSE. Yeah, large, unreasonable, questionable expenses belong to SBSE. There is a large business international, LB&I group. They audit companies like if you get a box on your stairs with a delivery, that's the kind of company they audit. Not guys like you, not guys like me. SBSE audits guys like you and me. When your expenses don't really match up with reality. Another thing they look at is, based on your industry that you're operating in, what are the usual expenses? They have a large group of people that they can compare your expenses and income against. If you fall well within the range, chances are you may not get audited. But if you fall outside of the range, you may get your return reviewed and perhaps audited. Some things to keep into consideration. Because it's not because the IRS dislikes business owners, and it's not because they're an easy cash grab. It's because business owners have the opportunity to use more discretion, have more, we'll call them judgment calls, and there's also a lot more room for error on the return. And for abuse. We've already covered high expenses relative to the income, right? And it's even more so when they repeat. So the IRS doesn't typically select 1 year for an audit. They're gonna select 2, and then if there's profit there, meaning they made tax, they're gonna audit a third. And I've seen repeat customers get audited 11, 12, 13, and later 14, 15, 16. Why? Because the IRS looks for patterns. Patterns of behavior typically repeat themselves. I've heard it said this way once in an audit. If it looks like a duck, smells like a duck, quacks like a duck, probably a duck. So if they can make earned income on one audit and they audit one return, chances are they're gonna audit another return. Because like I said in the beginning, it's all about patterns. Patterns of behavior that repeat themselves. And a business that typically loses money year after year is gonna look a lot more like a hobby. That's called activities engaged in not-for-profit. Internal Revenue Code Section 183. And the IRS looks at that and they say, according to the law, you need to show a profit in 3 out of every 5 years, 2 out of every 7 if you're into horse racing or horse rearing. But yeah, 3 out of every 5 for just ordinary people like you and me that don't do things with horses. And if you're not making a profit, that's kind of a trigger for them to say, perhaps we should review this return, or maybe even bring it in for an exam and see where they arrived at their figures. They're polite like that because when they start asking questions, audits follow. And there are certain credits that get a little extra scrutiny also. The first one that comes to mind is the Earned Income Tax Credit, or EITC. The shorthand for this is the Robin Hood tax. Rob from the rich, give to the poor. Lower income taxpayers that have a kid or 2 or 3, maybe I think the max is 4 for this calculation, and they pay very little tax, if any, might get a very large refund, like to the tune of $4,000, $5,000, $6,000. Senior citizens, if they don't have any kids and they're still lower income, they might qualify for it, but they wouldn't really qualify more than $250, $300. But EITC can be abused. Frequently, it is abused, not by necessarily the same taxpayers, but that will happen, and the IRS will call that in for exam, but by tax preparers. So if all of the returns prepared by one tax preparer all turn out to be EITC, they come up with a big Earned Income Tax Credit, which is free money from the government, that preparer might have all of his returns audited, or your return might be audited as a result of being prepared by someone who disingenuously claimed a credit that you didn't deserve. It doesn't mean that you did anything wrong. It just means that the IRS wants proof that you deserve that credit. And here's the one that most people didn't expect: filing your return late. Late filings aren't just about the penalties that come along with late filing. Late filing breaks a pattern of behavior. That disrupts their timelines at the IRS. And that makes your tax return stand out against all of the other people that filed their return on time. That gets the IRS's attention, and that attention matters. Another quiet trigger for an audit is fixing things after the IRS has audited you. Yikes! People think that responding will reset everything. Responding is important, but fixing everything before the IRS takes a look at it isn't. They kind of think you're trying to clean up your act. They're going to take a look. Sometimes responding early really matters. Other times it can make it look like you're trying to hide something. And it might make the IRS think that they found something that you're trying to hide that they'd like to see. And now they're going to dig deeper. This is usually when people say, hey, I didn't think that mattered. Most audit triggers are not that dramatic. They're just simply small little things that repeat themselves. And that repetition gets noticed. Here is the most important thing to understand. IRS audits do not happen because the IRS thinks you might have cheated. It's not their thing. It starts because they notice a pattern of behavior got disrupted. Something changed. And they'd like to look into that. Why'd that happen? This return doesn't seem to fit the pattern. That's it. Once the review starts, that intent gets evaluated. They're reviewing your return. They look and see what your intent for taking that deduction or this credit was. That's when they start thinking, maybe we should audit this return. But that pattern is what happens first. Another trigger is mixing personal expenses with business expenses. Shared accounts, unclear records, messy bookkeeping. Really, that causes attention. That confusion can lead to questions, and questions are what leads to audits. All they're doing is questioning your behavior. What happened with this pattern? Why did it change? Using round numbers can draw their attention very easily. When you do the math, rarely do you ever add up numbers and they end in zeros. You should never round numbers on your return. Are you an auditor? Neither am I. Are you an accountant? Everybody at the IRS is. They're using calculators every day, not rounding figures. Don't round figures on your return. The double zeros at the end are a huge red flag for audits. Big time. You're going to get caught with those double zeros at the end of your expenses. Because let's face it, real life isn't that clean. It happens every once in a while. Never more than once on a tax return. And the IRS knows that. One more trigger most people miss. Being connected to other people that get audited, that mess up their patterns of behavior. That can be a trigger for an audit. That could be business partners, employers, clients. So if the IRS audits one side, the IRS often audits the other side. So that's why when I do tax returns, I typically don't like to see a return that ends in double zeros. It's not personal, it's procedural. And the IRS follows procedures to look at disruptions in patterns. You want to know what reduces audit risk? Consistency, clarity, documentation, clear records, accurate filings. Not perfection. You can be clumsy with your tax return. Just be consistent. That's what makes a big difference. And here's the part that matters the most. Most audits don't become big problems until people handle them incorrectly or improperly or poorly. We'll say it that way. Ignoring letters, oversharing, guessing instead of verifying. That's where your costs explode. You see, audits are not the end of the world, and they're not DIY projects. In fact, an audit is a place where you have the most ability to have the most flexibility in working with the IRS by presenting how you came to your numbers on your return. Everything after that is collections. They've already figured things out. Now the burden of proof is on you, not the IRS. Because once that audit is over, that is considered, key word here, substantially correct. And you have to prove everything to the contrary with regular documentation, with regular records. And if you didn't present it in the audit, they're going to wonder why. So they're going to send you back to the same examiner. The earlier you find out why your return stood out, the easier it is to fix things about an audit. If you're worried about audit risk, the answer isn't panic, it's clarity. Because when the numbers actually make sense, the IRS actually moves on their way. They don't say they're sorry after they audited you, but they say, keep better records next time.